Welcome to China Perspectives, a podcast on economic and credit developments in China, featuring experts from within and outside of Fitch Ratings. My name is Jeremy Zook, lead China sovereign analyst at Fitch Ratings and co-host of this podcast. In today's episode, I'm joined by Lan Wang, a senior director in Fitch's credit policy group, to discuss credit developments in China during the first half of 2024 and what we can expect in the remainder of the year and beyond. In her role as part of the FitchWire team, Lan is responsible for monitoring and writing on economic, policy, and cross-sector developments in China and assessing their credit implications in coordination with the various analytical teams at Fitch. With this broad yet in-depth background on all things China, we'll be able to dig into a number of interesting topics with Lan today. Lan, it's great to have you here.
Thank you for the introduction, Jeremy. Very glad to be here today. So one big development during the first half of this year was the action on China's sovereign rating. Jeremy, as the lead sovereign analyst for China, it would be very interesting if you could set the stage briefly with the summary of the sovereign action.
That's right. We affirmed China's A-plus sovereign rating in April, but we revised the outlook to negative to reflect our view that China's public finance outlook is becoming more challenging as it deals with an uncertain economic transition away from property-reliant growth. During this transition, we think fiscal policy is likely to play a sustained and large role in supporting growth, which we think will keep deficits relatively high and push debt steadily higher, at a time when contingent liability risks remain quite a challenge. So fiscal buffers have already eroded from a ratings perspective following years of high fiscal deficits and rising government debt, particularly among local governments. Now, turning back to you, Lan, following the sovereign rating action, a number of other entities from sectors ranging from banks to corporates to LGFVs had actions taken on their ratings as well. How many rating actions did Fitch take following the negative rating outlook on the sovereign? And could you explain in a broad sense the rationale behind these actions, particularly in terms of sovereign support assumptions that feed into our methodology?
Sure. So recent sovereign action has led to outlook changes for more than 130 entities in China. And to understand the rationale from a broad sense, we think the rising risk on the public finance front, as you've just mentioned, indicate the government's capacity to provide extraordinary support to other entities could potentially decline. And that's why we saw many outlook revisions following the recent sovereign action. And to dig down a bit deeper, more than half of the affected entities are corporates and public finance entities owned by the central and local governments. So the central government-owned entities and their subsidiaries as well are more directly impacted, with their ratings either equalized or one or two notches below the sovereign rating. At the same time, we also revised our internal assessments of China's local governments after the sovereign action. And this had a knock-on effect on the corporates and public finance entities related to these local governments. So for these entities, including ones owned by central and local governments, it's very important to know that the outlook changes that we saw is not about the likelihood of government support, but about a potentially reduced capacity for such government support. And it's also worthwhile to mention that some private corporates were also affected by the latest sovereign action. So as for financial institutions, mid-tier banks and securities companies remain largely unaffected, but we did revise the support factors for policy and state banks and China Merchants Bank to also reflect a potential decline in the sovereign support ability. So as a result, these banks' leasing and Hong Kong-based securities subsidiaries were also affected by the latest sovereign action. Within financial institutions, insurance is a bit different. We did revise the outlooks on 6 China insurers. Then this stems from our thinking that for insurers with weaker standalone credit profiles, for these insurers, when they face times of financial stress, we believe there could be a potential decline in both the willingness and ability of government to support. But on the other hand, for ones that have stronger standalone credit profiles, for example, China Life, although its rating is already at A+, that is the IFS rating, with a stable outlook, it hasn't been affected by the latest sovereign action.
Thanks, Lan. Now I'd like to turn to the more recent macroeconomic developments. So Fitch recently revised up its forecast for China to 4.8% in its June global economic outlook. This is from 4.5% in its March update. What were the key factors behind this upward revision, and how does Fitch see some of the lingering challenges, particularly coming from domestic demand?
Right. We recently updated global economic outlook and revised up China's GDP growth forecast for this year, as you just mentioned. And this revision mostly reflects the first quarter data, which surpassed our previous expectations, especially in exports, where we saw a surprisingly strong rebound. However, there are still lingering risks coming from domestic demand within China. For example, in the first quarter, its contribution to the overall growth slowed even further. And we think the deepening property sector downturn and its resulting negative wealth effect on households is certainly a key factor that is weighing on consumer sentiment and delaying a recovery in domestic demand. And the recent property market data, for example, home prices, are pointing to a more prominent downward pressure in the sector. And also one thing to keep an eye on is the third plenum, which is set to be held in July this year. And this is where the party leadership, they're going to prioritize their medium-term economic agenda at this plenum. Is probably likely to provide more insight on how some of these economic challenges might be addressed.
So you mentioned the property sector as a continued drag on the economy. Now, on May 17th, the government did announce most significant measures to date to support the property sector. Could you quickly outline some of those measures, and how effective does our property team believe that these measures will be in stabilizing the property sector?
Sure. So the PBOC, China's central bank, announced on May the 17th that it will establish a re-lending program totaling RMB 300 billion. And this program will help local state-owned enterprises, that's SOEs, in purchasing unsold homes. And these SOEs will then convert these homes they purchased into rental properties. And we believe the large unsold housing stock in many cities in China is not only constraining property developers' liquidity at the moment, but also weighing on home buyers' confidence. And this policy move, that is the re-lending program to support home purchases by the local SOEs, will certainly reflect the government's increased efforts to reduce the currently high stock of unsold homes. The central bank, the PBOC, projects that 300 billion re-lending program that they are establishing could catalyze up to 500 billion RMB in bank loans in total to support the purchases of unsold homes by the local SOEs. But we expect even if this program is fully utilized, it will only allow local SOEs to acquire probably only a minor fraction of the total inventory of unsold homes. At the same time, the government also announced several other measures. For example, the removal of mortgage rate floor. But these measures are mostly to reduce mortgage rates and also the down payment requirements for home purchases. And also to revive the home sales. Most cities in China have also removed their local purchase restrictions by now. Overall, we think recent policies could help stabilize home sales mostly in higher tier cities, but their broader national effectiveness remains more or less uncertain. New home sales continued to contract recently, and we expect new housing sales this year to fall further from last year's levels. And we now also forecast a 5% decline in average selling prices on a nationwide basis this year. And this incorporates the year-to-date trend and also the potential policy impact. And also in the long run, we see housing demand dropping to around 800 million square meters per year over 2024 to 2040 on average. And this is down by 33% from actual average demand in 2011 to 2020.
Banks are being asked to play an increasingly important policy role in supporting both the economy and managing potential risks. And this relates not just to the property sector measures that you just highlighted, but also to helping manage risks from LGFVs. How does our banking team view the situation in the banks right now, and how do they see the outlook for the sector?
To answer your question on banks, the latest policy measures are putting a squeeze on banks' net interest margins for sure, and also their overall profitability. So, for example, the removal of mortgage rate floor and also the reduced mortgage rates will tighten banks' net interest margins even more this year. And this comes on top of the pressures from reduced loan prime rates, mortgage repricing, and other policy mandates to support the economy. And meanwhile, we expect banks will continue supporting the resolution of LGFV debt risk. And this means in a weaker economic scenario, which is not our base case, policy goals could overtake commercial interests, especially for major state banks. And this could further strain banks' profitability. And across the sector, banks' net interest margin has already contracted. dropping to 1.7% by end 2023, and that is from 1.9% at end 2022. Although further cuts to the reserve requirement ratio and also deposit rates could potentially mitigate some of the margin pressure, but the pace and magnitude of these potential cuts are probably uncertain. And also on the asset quality front, the situation looks somewhat different. The resolution of LGFV debt risk, we believe they could help ease some asset quality stress for the banks in the near term. We also don't think the property support measures that we are seeing will weaken banks' reported asset quality metrics significantly. And this is because, despite the reduced down payment requirements, we expect our rated banks will likely maintain cautious underwriting and also a broadly stable risk appetite. And most new mortgage originations, we expect they will likely concentrate in the higher tier cities, and collateral valuations in these higher tier cities have typically been more stable.
Thanks. I'd like to end with one final question on what has been certainly a big news item in the recent weeks, and that is the imposition of tariffs by the EU on Chinese electric vehicles. And this indicates that, trade tensions are perhaps on the rise with actors beyond the U.S. As well for China. Now, Chinese firms have taken the lead on innovation and sales globally in the EV sector, and this has been quite a promising new industry for China. How does Fitch expect these tariffs to impact the EV sector and the credit profiles of Chinese car makers?
Right. So there certainly have been several recent developments on this front. For example, on June the 12th, the European Commission pre-disclosed the provisional countervailing duties for China-made battery EVs. For example, Chinese car makers, they would be subject to duties of up to 38.1%, and that is on top of the ordinary 10%. And other battery EV producers in China, they may be charged 21% or 38.1%. Depending on their cooperation with the Commission's investigation. And also last month, the U.S. government proposed tariff hikes on China-made EVs to 100%, and the U.S. tariffs will also affect various key inputs into the EV supply chain. And these developments certainly highlight the escalating trade tensions in the EV sector and indicate the risk of more trade barriers are likely in the future. We do expect Chinese car makers, they will respond to these developments and also the rising trade barriers by increasing investments in alternative markets and also diversifying their production facilities. This is actually a trend that we're already seeing in recent years. And these car makers, they may also choose to form joint ventures with partners in markets with lower trade barriers. And such strategic moves could result in higher capex or equity investments and also increase cash outflows for these Chinese car makers in the future. As for China's domestic market, as EV exports face tougher conditions, competition in the domestic market could grow further. And this could even possibly push an even faster transition to EVs in China's markets. And this may lead to a decline in market share for traditional vehicles and impact the profitability of some Fitch-rated Chinese car makers and their international joint ventures. Also, I would like to mention that car exports from China have actually continued to grow this year. And as trade barriers rise, we also expect a shift in the export mix towards emerging markets. Over time, as Chinese car makers, as they expand their overseas manufacturing production, we do expect sales in these markets to be increasingly met by locally produced vehicles.
Great. Thanks again for joining us today, Lan, and sharing your insights. 2024 has certainly been quite an interesting year so far for China credit. And as we've discussed, there are certainly a range of issues to watch closely over the remainder of the year. You've been listening to Fitch Ratings China Perspectives podcast. To learn more about our ratings and research on China, visit us at fitchratings.com. And please subscribe to China Perspectives on iTunes, Spotify, or wherever you get your podcasts. Take care until next time.